Hey everyone, today we turn our attention to economics and taxation, and really government expenditure. And government expenditure requires revenues. That revenue we call taxation. It is true that there's many different areas where the government receives money. Fees is a good example, especially if you are doing some type of work in your local system, like a local government. They tend to have more fees. Good examples, if you buy a home, there's a fee attached to it. If you want to expand your home, it's a fee attached to it. If you go down to City Hall and try to do some work, there's typically a fee associated with that. There's fewer fees with the federal government, but they compose a larger component of smaller systems, including the state. For instance, DMV is a fee. The Department of Motor Vehicles charges you a fee if you have a car. So there's a number of systems in government that are trying to at least pay for their expenses more on what we would call fees than actually tax revenues. If you remember, some years ago, most of the city services, state services, and federal services were paid through taxes. Taxes have not kept up with expenses. So there's been a plethora of fees that have risen over the years because taxes have not kept up, again, with expenses. And a good example is using freeways. Quite a few freeways, especially on eastern United States, will have some kind of tax system or some type of toll system. They're even using them in Los Angeles, Southern California, as a way to bring in more money into the government. Why do they need to bring in more money to the government? Well, they have to bring in more money to the government because there's not enough money currently in place. So let's go back just a bit and talk about taxes and what taxes are. We have a progressive tax system in the United States. The other type of system would be proportional, also known as like a flat tax, which everybody pays the same percentage. So it doesn't matter if you make $1 million, $1 billion, or 1,000, you would pay the same rate. Great sense of fairness to that when you think about it. No matter what you make, you pay the same flat tax. It's very easy to manage. You just take out the amount of money that you make and you give a certain percentage to the government. When we look at the billions of dollars spent determining what a person needs to pay for their tax, we can eliminate quite a few taxes just by having a flat tax. But is that flat tax fair? In one way, as I mentioned, it is. In other ways, it may not be. Some people think it's a regressive tax. For instance, if you make $1,000 and the tax rate is 10%, you lose $100 of 1,000. If you make $1 billion and you have to pay 10%, then you lose 100 million of 1 billion. You certainly have a lot more money left over. There is a thought in progressive societies that if you make more money, then you should pay more in tax. Progressive. The people who pay progressive taxes think that that's in some ways unfair. For instance, if somebody had one job, and let's just say they made $20,000, if the flat rate was 10%, they pay $2,000 out of 20. If they had a neighbor that did the same thing, and they made $20,000, 10% of $20,000, again, $2,000, and then it's fair. They're each paying the same tax, and they make the same money. But let's say the one person who makes $20,000 continues on that job and makes $20,000, but the other one wants to make more money. They want to improve their station in life. So they get 2 jobs. For the sake of ease and rounding, they get 2 jobs at $20,000. So the one person who now has more time to spend at home because they only have one job, they pay $2,000 in taxes out of $20,000 in income. The other person, when he gets home from work, his first job, he goes to his second job. He spends less time with his family. Maybe has more health issues because he's working so much. But he's now making $40,000. Ideally, 10% of $40,000 would be $4,000. He would write a check for $4,000. But our system says the more you make, the more you pay. So instead of paying 10%, for the sake of rounding, let's say he pays 20%. So now instead of paying $4,000 in taxes, he pays $8,000 in taxes. Proportionally, he is paying much, much more than just 10%. Let's say the rate goes up to 20% if you make between $20,000 and $40,000. Again, rounding errors, we're just using round numbers. And some would say, if this person wants to spend their time on a second job, trying to better themselves, save money for investment, maybe put their children in better schools, get a bigger house, should they be penalized with a higher tax rate? That is the conundrum that we see within the United States. The slide before you talks about what's called the marginal tax rate. And how our system works is that you pay a certain rate based on how much you make, but the more you make, you pay a higher rate on that specific income. So you wouldn't pay your entire salary or revenue or income on that higher rate. As an example, if you make $85,000 to $178,000, you'd pay $28,000 on that income within that range. But if you make over 178, let's say you make 178 to 388, then you would actually pay 33% on that additional income. So you would pay some at 28 and some at 33. Some would say that you get penalized for making more money. There's a disincentive to make more money because you pay higher taxes. By the way, there's also states that have a progressive tax rate. So in addition to paying higher taxes to the federal government, you're going to have pay higher taxes to the state government. There's also some entities that have a city tax. New York comes to mind. So our system says that as taxes, or as your income goes up, your taxes will rise as a percentage. And that is meant to bring more money into the government, mainly because the government doesn't have as much money to spend as they would like. Interestingly enough, most people don't know when taxes started or what the tax rate was. Taxes started at actually 1%. And less than, by the way, the max was 7%. So when taxes first started, they started at 1%, and the maximum tax rate was 7%. You'd be interested to know that less than 1% of the population paid that tax. Most people didn't pay taxes. It's an amazing increase. Today, what you see is the top 1%. When you add up all the income in the United States, those are the top 1% in terms of income. They make about 17% of all the income in the United States. The 1% makes about 17% of all income. But they pay close to 40% of all taxes. Yes, 1% makes about 17% of all the income in the United States, and they pay more than double of all the taxes. In fact, if you look at, for instance, the top 10%, if you look at just the top 10% in terms of income, they pay close to 40% of all taxes. 40% of income, excuse me. So the top 10% make about 37, 38% of all income in the United States, and they pay about 72% of all taxes. The top 10%. That means that the bottom 90% in terms of income pay less than 30% of the total federal income taxes. So when we look at who pays the taxes in the United States, it is, by and large, the top 10%, the more wealthy. Most people don't know that. But it is something to know because, as we're going to talk about from an economics viewpoint, how much is too much taxes and what's the impact of taxes on our systems. Are taxes a good thing? Certainly. They're a really good thing. One of the pros of taxes is, especially the progressive taxes, that there's a redistribution of income. In fact, much of federal government spending is redistribution. Almost 70% of the federal government's tax system, spending system, is taking money from one person and giving it to another person. And a good example is Social Security, Medicare. That money is taken from some people who may not need it or use it and given it to those who do need it. Most don't remember or know that most of federal spending is in what's called transfer payments. So having a progressive income policy in terms of taxes means that the upper middle class, and upper class pays the majority of the taxes. Those taxes are used for people who are not in those categories. And so there is a redistribution of income with a progressive tax. The flip side, of course, is if everybody paid the same tax rate, there would be no redistribution. You pay based on what you earn. It does talk about, with progressives, the ability to pay. Everybody has the ability to pay. But the key is the consequence of paying. So if you have a tax rate of 20%, then if you make a very low income, there might not be as much money left over. The government, and by the way, the government is just the people, and the people are one more than half. So one more than half of the people, in this case the United States, have said that we want people who make more money to pay more of the taxes. In fact, when you look at democracy in general, democracy is a system where at some point a majority of the people can vote themselves certain advantages, certain benefits. The hope is that the majority does not do that. We look at the whole. One of the best examples that I can give is there's very few people who don't want to at one point be rich. One of the great things about the United States is almost 80% of anybody who's a millionaire, about 8 in every 10 millionaires, made it on their own. Not family money, didn't inherit it, they made it on their own. This is a country still where if you want to make it, you can. There's not a person I meet who doesn't have some type of disadvantage or challenge or barrier. Everybody does. My dad was a garbage man. My mom was raised on welfare. Some of the barriers they had, my mom had no food, as she didn't have a father. Very tough upbringing. She made it, though. She made it because she worked 2 and 3 jobs. My dad also had 2 and 3 jobs. They worked for it, and they worked in a country that said if you work hard enough, save your money, invest, have a good idea, watch your expenses, that you can make it. So what we need to be careful of economically, when we talk about taxes, is to have a tax rate or a tax system that punishes people who make more money, because at some point we all want to be there. And once we get there, we would find that it would be unfair to take most of our money away. So we don't want to disincentive the people who are there, or the people who want to get there. It would be unfair and unwise for those who are not at that level, either upper middle class or upper class, to create barriers that once you get there, so much of your income and your status is taken away to give to other people, because those other people may at some point want to be in that exact same position. And when they're in that position, they would not want that same circumstance to happen to them. It's a good way to think about taxes. The interesting thing about progressive taxes is there's really no good evidence of redistribution. We think that there's redistribution, but there's really no strong evidence, no tie that says that there is a redistribution aspect associated with taxes itself. Benefits, yes, but not necessarily with taxes. That's because there's not necessarily a direct benefit. So, for instance, if you don't make much money, you may not pay much taxes, but you also don't get much taxes back, or much income back. As an example, if you make $30,000, you're certainly not paying much in taxes. However, you're not going to get money, for instance, $5,000 or $10,000 from those who did pay taxes, so you're not going to get a bonus. Even though you're not paying taxes, you're not going to necessarily get additional money. The hope, here's the hope. And if you listen to one of my other videos, I made this argument as well. The hope is that those who make less money, which tend to be younger people in their career, are younger in their working life, that you make less money and you pay less taxes. But you take that money and invest in yourself. You create your own research and development account. You create your own educational account. You save your money. You think about a business that you want to make. And then you start building that business. You're not paying much in taxes, so you use that money to build and rebuild something that works for you. And over time, maybe you make more money, whether you progress in your organization or create your own business. And eventually, you'll be in a position, if you work hard, if you have a great idea, if you have a little bit of luck and a little bit of help, then you'll be in a position maybe in 10 or 15 or 20 years where you're making the kind of money that you only dreamed about 20 years earlier. Then your taxes will go up somewhat. So that's the hope. The hope is that when your taxes are low, you use that money that you're not paying in taxes to better yourself, to create your future, to put yourself in a position where then you will make more money in 10 or 20 years, and then you'll have a higher tax to pay. It's very similar, again, what I mentioned a couple minutes ago, what I said about the United States, where we typically have fewer exports and more imports. We have trade deficits with many countries, including the European Union and China. We spend more money on their goods than they spend on ours. There's many other countries where we had trade deficits as a country. But we do that with the hope that that country will take that money, that difference between what they're sending to other countries and what we're sending there. They'll take that money and they'll rebuild their infrastructure, rebuild their educational system, and then they will raise their standard of living. And so over time, they'll be able to buy our goods and services. We'll create a market for our product so that in 5, 10, or 15 years, they will start buying more from the United States. That's the hope. Taxes and imports and exports have a very similar concept. We also have corporate income tax, much debated here in the United States. Corporate tax is often a form of double taxation, so it's one that we really have to be somewhat careful about. Corporations are owned by, it's an entity owned by shareholders for the most part. If there's income made by corporations, they typically distribute that to people who work there. So you don't necessarily want to charge a corporation a high amount, and then when they distribute monies to people, they get charged as well. It can be a disincentive. It also can be a disincentive if corporations are looking at making an investment, and in addition to borrowing money and taking a risk, if they have to calculate that 12, 15, 20, 25% of whatever money they make goes straight to the government, when they start to calculate whether they should make that investment, the higher the taxes, the less incentive they have to make that investment. Since government really exists because of corporations, by the way, corporations are those that employ people who then pay income tax, governments are hesitant to raise corporation taxes too high because they know that if corporations do not have a sense of risk and incentive that's manageable, and if they don't see rewards in investing that money, they won't do it. They won't hire more people. They won't invest in a community, build buildings and production plants. The higher the rates of taxes, the less they're going to be incentivized to do so. We also have other taxes, and then I want to show one other slide. We have Social Security taxes, which is about 14%, 14.5%. Everyone pays Social Security taxes. Social Security taxes started in 1935. They started because during the recession, most people didn't have some kind of savings account when they got older. They relied upon the government. The government says, we're not going to do that anymore. So they now, at the time, they took that 1%, again, very similar to income tax, 1% charged to the employer, 1% charged to the employee. And that money went into a savings account. When you retired, you got that money back. That's the thought, at least. Today, the Social Security system is woefully underfunded. And it's underfunded because there's too many people receiving benefits and too few people paying in. I think the figures were, at one time, there was about 35 people paying into the Social Security system. There's one person who was receiving benefits. Today, if the figure is about right, you have about 3 people paying into the system and 1 person getting benefits. So, over time, we've had way more retirees than we do people paying in. Part of that also is we've expanded it with people with disabilities and people who lost their parents before they were 18 years old. Very laudable examples to give people money. The government, though, didn't want to provide those individuals money. So what they did is they took money from Social Security. As a result, Social Security is a broke system that's relying on monies from other people. We understand that it's not too far along that there really won't be any money in that kind of what they call a trust fund, and they're going to have to make even more adjustments in terms of Social Security. Social Security taxes have increased about 35 times since 1935. They continue to go up, and the system still is not solvent. Unemployment taxes. Unemployment taxes are paid by the employer, and that's to give people money if they lose their job, at least for a certain period of time. Again, the government used to have to give those people money if they lost their job. The government is saying, we don't want to provide those people money. We want employers to pay for that. So the government, again, as I mentioned a couple of minutes ago, is trying to figure out ways that when something negative happens to the population, that the government doesn't have to step in and pay for those expenses. This brings us to a slide that I think is quite telling about maximizing tax revenue. There's many different charts like this, and this is just one. And there's some numbers on here, but sometimes the numbers don't mean as much. But what we want to walk away from this chart with is that there is a dynamic that talks about the more that you tax, the less money you get. In fact, there are some people who think taxes are so low. The first thing that we should say is, okay, if it's too low, what do you want to raise them to? Well, raise them to 80, 90%. There were some countries in the 1970s and 80s who had a 98% tax rate. And can you imagine if you went to work every day and let's say you made $100,000 a year, and at the end of the year the government said you need to give me $98,000 of that money. How would you be able to live? Would you be incentivized to work all year for $2,000 when somebody else got $98,000? It moves from capitalism to what's called communism or socialism, which everybody shares everything. What we know about capitalism and what we know about taxes is no different than what we've learned as a child. If you give somebody an incentive that they want, they often will work for it. It gives them that personal encouragement to achieve that goal. If you disincentivize somebody, it's going to be very difficult for you to encourage them to accomplish their task. And that's what this chart shows. It shows, and this is in regards to sales tax, that if sales tax are too high, people just won't buy anything. A good example was some years ago, the government thought that they would tax yachts. Yachts are big boats that rich people buy. And so the government said, we want more money, so we're going to tax yachts. So every yacht that was built had an additional tax on it that people had to pay if they wanted to buy that yacht. You can imagine what happened. The yacht industry, by the way, which is supported by regular average people like me and my dad, lost their jobs. They lost their jobs because people who were going to buy yachts decided a yacht is good at X, but when you're going to charge me X plus Y, it's too expensive. I don't want to buy a yacht at that rate. So they stopped buying yachts. So although they had a tax that said, let's put, I'll make this figure up, a 10% tax on any yacht that's sold. People said it's not worth it to buy a yacht anymore. We're not going to buy yachts. People aren't buying yachts. You stop building yachts. If you stop building yachts, people lose their job. Over time, the industry, which is on the eastern coast of the United States, was in grave danger of going out of business. What did they do? They dropped the tax. That's a great case study. Take a look at it if you ever get a chance. It happened during President Clinton's period. And this is just one example. There's others as well. But if you start to tax something, most taxes change behavior. And if you institute a tax that's punishing, that is too great for what people get in return, they won't buy it. You'll change the behavior not to continue to purchase the product and pay the tax, but to not purchase the product at all. The same goes for the progressive rates. If it's too high, people will not save money. People will not invest in a business. Because when they have to look at their return on investment, and they have to say something like, yeah, I can take a loan on my house, which is a risk. I can open up a cake making business. But now, instead of every 10 cents I make going to the government if I make a profit, every 20 cents I make. When I add that to the interest I have to pay, plus what I'm risking by a business that may not work out, that risk is not worth it anymore. I've been de-incentivized to take that opportunity. We'll talk more about it. It's a fascinating subject. If nothing else, it's something to think about. We don't know what the right tax rate is. We certainly don't know what the right level of spending is. But we should have a clear understanding of what taxes are and what they do. What are proper taxes and improper taxes? What's a good role of government and not? And then we should work to try to mold our government to see things the way that maybe we think they should. Nothing else, we should at least participate. Thanks, everybody. Enjoy the day.